As of April 3rd, 2025, President Trump has enacted new steep tariffs that have sent shockwaves throughout the global economy and are triggering fears of a recession because the markets have fallen more than 17%. Right now, the financial news is filled with headlines that stoke fear and panic, and it's easy to feel overwhelmed. And maybe you might be thinking, like, is it even worth putting my money into the stock market right now? Or maybe I should just sit on the sidelines until things cool off. Look, I get it. The uncertainty can be scary, and there's so much unknown about what might happen next. But here's the thing, while a lot of people are selling everything and running for cover, there are some investors that are using this downturn as an opportunity to quietly build their wealth. So in today's video, I'm going to share with you how I'm personally responding to this market hysteria and how you can get rich from any bear market or recession by staying calm and having a long-term strategy. But first, if you're new here, welcome to The Choice Life. My name is Rachel. I am a financial coach helping women start their journey to financial freedom. So I want to start by saying I'm not a financial advisor and I'm not giving investment advice. I'm just going to share with you what I'm doing right now in the market. So the first thing that I'm doing is staying calm. So I'm a long-term investor. I do not trade, I don't day trade, I don't trade options or individual stocks. When I put money into the market, I don't need it next week. I don't even need it in 6 months. I have a 20, 30, 40 year time horizon. So that allows me to be able to put money into the market and just really forget about it, honestly, because I'm not using money that I need immediately. So because I have a long-term approach to my investing, that allows me to be able to withstand all of the market volatility. So the market has gone down a lot, like I said, 17%, and it really doesn't matter that much to me because I don't need that money right now. I'll need it in 30 years. And in 30 years, it will most likely be up because historically the stock market always goes up. So I'm really not panicked. I'm really not worried. Actually, I'm excited because now everything that I'm buying is on a discount. So if you went to Macy's or if you went to Best Buy and they had a 17% off sale, would you run out of the store? No, you would run into the store and you would try to get everything that you can buy. And so that's kind of how I think about investing in the stock market right now. Everything has a 17% off sale. And so I am excited. I'm using this as an opportunity to buy more aggressively. So basically what I do is I dollar cost average into the stock market. So that basically means that I invest the exact same amount of money into the stock market every single month, no matter what. Whether the market is really high, I'm investing, or if it's really low, I'm investing. So the benefit of dollar cost averaging is, one, it takes the emotion out of your investing. So you are investing no matter what the market looks like. But another benefit is it averages out the cost per share because, like I said, you're investing whether the market is up or whether the market is down. So in the long run, you buying high, you buying low, you're buying in the middle, it will all average out and it'll lower your cost per share. So using the dollar cost averaging method allows me to stay calm during any sort of market volatility and continue to invest. So I know for a lot of people, they are tempted to pull their money out of the market right now because they see the value in their portfolio is dropping rapidly. But I would just encourage you not to do that. I'm not pulling any money out of our investments. And the reason is because say you had $100,000 in your investment account before April 3rd, and now it's at, say, I don't know, $80,000. So you're like, oh my gosh, I've lost $20,000. Let me pull the rest of my money out so I don't lose any more money. Actually, what you just did is you locked in those losses. So if your value went down to 80,000, that's just paper losses. You didn't actually lose that money because you haven't sold. So if you just wait, then as the market, cools off and actually goes back up, you can reach back to that $100,000 and even more if you keep your money in your investment account. But when you take that money out of your investment account, you actually locked in those losses. It's exactly what experts say not to do. You're buying high and you're selling low. And you want to do the opposite. You want to buy low and sell high. So right now, the market is low. The market is lower than it was at its all-time high. So this is the perfect time to actually be buying stocks, not taking the money out of the stock market. So I want to share with you this chart that I found through JP Morgan. They did a study called the tied to retirement. And on this chart, it's talking about how when the markets go down, usually the worst days to invest are very close to the best days to invest. And if you miss the best days to invest because you pulled your money out during the worst days to invest, then your returns can be drastically cut. So on this chart, it will show that if you kept your money fully invested in the market during the best and the worst days of investing, then say you put in $10,000 between January 3rd, 2005 and January 31st, 2024, then you would have $71,750. So that would have been a 10.4% return. But if you actually pulled your money out and you missed the 10 best days of investing, just 10 days, if you just missed those 10 days, your return would be $32,871. So that's just about half of the amount that you would have if you just stayed invested. So this chart shows you that when you allow your emotions to cause you to pull your money out of the market, you could be costing your financial future a lot. That is why it is so important to have a long-term perspective when it comes to investing, because if you pull your money out thinking you're protecting yourself, you could be missing out on those best trading days because they usually happen very closely to the worst trading days, and that could make a big impact on the future growth of your portfolio. And I find that a lot of people, when they pull their money out of the market, they don't know when the best time to get back in the market is, because now you're trying to time the market. And experts have always said it's not about timing the market, it's about time in the market. So my recommendation is to stay patient, don't panic, stay invested, and just give the markets time to rebound and go back up, because historically they always do. And that also goes for you if you have not yet started to invest, but you want to be investing, but all of this market volatility and hysteria is scaring you away. I would not recommend sitting on the sidelines. I would recommend go ahead and start investing, because it's the best time to start right now, because you're going to get more value for your money. And another reason this is a great time to start investing is because it will help shape your perspective on investing. When you see that the markets can drop this drastically, but the markets will also go back up, it helps you to have a more long-term perspective, and it helps you to have a less emotional perspective. So going through market downturns is actually a good thing, because it helps you to shape your asset allocation in a way that when the markets go down, you won't just sell everything. If you're interested in investing and you would like to get started, I want to share some things that you have to have before you get to this point of investing. And the first thing is a budget. If you want to start investing, you have to know how much you can invest each month. And the only way to know that is if you have your money organized. And that's basically what a budget does. It helps you to organize your money and tell your money where to go. Because when you start investing, you want to be able to be consistent with it. But if you don't know where your money is going or how much you're saving every month, you will not be able to be consistent. So get on a budget. That's step one. Step two is to build an emergency fund. So when markets tend to be volatile, that usually coincides with the job market being volatile. And we have actually already seen that in the first quarter of 2025, with all of the federal workers being laid off and just so many industries laying off workers. The job market is incredibly volatile. So when this happens, you want to make sure that you can withstand anything that happens. So an emergency fund will help you do that. So I like to think of an emergency fund as the roof over your financial house. It protects you from the elements and it keeps you safe. When you don't have an emergency fund, you are vulnerable to any unexpected event, whether that be a job loss or your car breaking down or any medical emergency. And that means that you have to rely on debt, which then increases your risk. So getting an emergency fund is top priority before you even think about investing. Step 3 is to pay down any high interest debt. And the reason this is so important is because if the interest that you're paying on any of your debt is higher than the interest you would get in the stock market, it makes zero sense to invest. So if you are trying to get 10% in the stock market all the while paying 18% to a credit card, that's losing money. That is not a good trade. So I would recommend paying down that high interest debt first. And I know you might have that itch to start investing. You're like, I need to just start. I need to get in. And I feel you. Yes, starting to invest is very important, but you have to do the first things first. You have to get this debt out of your life, because once you get that debt gone, then that's more money that you can put into the stock market. So once you get your financial house in order by getting on a budget, getting an emergency fund, and paying down any high interest debt, then don't wait. Go ahead and start investing, because when you have that stability in your finances, that allows you to have a more long-term perspective when it comes to the money that you invest in the stock market. Okay, so I gotta go. My baby just woke up from her nap. But basically, this is how people get rich during a bear market. They take advantage of these downturns and they stick to a long-term investing strategy. So I hope that this video has been helpful for you. And if your goal is to reach financial freedom and become a millionaire, then watch this video next, where I talk about how we're becoming 9 to 5 millionaires on just one income. And I'll see you there.